Okay, this is going to start Chapter 10, and we're only going to do the first 3 questions because, as in Chapter 9, after a certain number of questions, the textbook answer guide then gave detailed explanations, so we'll only do the ones where there are no detailed explanations. I think it's 1, 2, 3, and 6. 4 and 5 have, and we're only going to do 1 through 6. So let's get to it. Number 1 asks, how is the following allocation of business assets made? And that's clearly what we said in this liquidation, this dissolution of partnerships, what we said in class, is that that's where the capital accounts become the law, and that's why answer C is the answer there, because it's according to the final capital accounts is how that gets distributed. And we go down to 0, but not below. If we go below 0, then we either have that capital deficit restoration requirement or the qualified income offset requirement, either one of the two. We discussed it in class. So question 2, which of the following statements is true concerning the accounting for a partnership going through liquidation? And here, this is a great question because we did say this is liquidation accounting principles in its finest, which is what the AICPA CPA exam may be starting to ask questions about, because there was a big article about it a couple years back in the Journal of Accountancy, liquidation accounting, and here it turns out that answer A is we skip the income statement. If there is no income statement, the only place to put gains or losses are directly to the capital account, the equity accounts, and that's what happens, and that's answer 2. All right, so we can go to question 3. Let's see what we have. During liquidation, if a partner's capital account balance drops below 0. So this brings out the point I was saying before, so that's good, so we can reinforce it. What should happen? D is the what should happen. The partner with a deficit contributes enough assets to offset the deficit. That's what's known as, and let's just cover it again, that's what's known as deficit capital account restoration. And it should say capital account restoration, which means they restore the deficit by putting money back in. As I mentioned in class, you really don't want that to be the case. The best way to go is the tax way, or I should say the tax phrase for the other way to go is qualified income offset, and you can look at the text to see how the text calls it under GAAP accounting. It's a slightly different phraseology, but capital income offset, qualified income offset is the tax phraseology, where the where happens is that the rest of the partners pick up losses. They pick up negative losses, and the deficit capital account partner, so the one with the deficit, picks up income to balance the entry, and so they just pay some more income tax on that money. So it becomes income to the negative capital account partner, and it all balances out. So if you think of it this way, one more way of looking at it is, let's say you got partner A with a negative capital account of 100. So what we'll do is just credit him 100 with some kind of, it's phantom income, but we're allowed to do it for book and we're allowed to do it for tax purposes. And so B and C, if let's say they were equal, they'll just share and they'll get deductions, and A will pick up income, and everybody works out. So if A had a negative capital account of 100, now we credit it, and he winds up at 0, just where it should end up. But the legal the default is this, where it's a deficit capital account restoration. Okay, let's see. I think question 6 we need to do. That's not described in the textbook with detailed explanations. Let's see what it is. What is a pre-distribution plan? It's a guide for the cash distributions to partners during a liquidation. That's exactly what it is. So number 6 is A.
need someone to take you to the bathroom, you're welcome.
It is not a list of procedures to be performed during a liquidation. It's not a determination of final cash, and it's not a detailed list of transactions that will transpire in the reorganization. It's simply a guide for the cash distributions to partners during a liquidation. That's what it is. I'm not sure that's a important definition,
Right.
but it's part and parcel of some test banks I saw for CPA exam review, so I threw it in here as well. All right, that's it. Look for the detailed explanations of 4 and 6, and let me know if you have any questions.